and welcome to the Ideal Investor Show. My name is Axel Meyerhöfer and I'm the host of the Ideal Investor Show, where we show you the path to early retirement. Hello, Mark. Welcome to the Ideal Investor Show. So glad that you could come and make time for us. So could you please introduce yourself a little bit, tell us and our audience what you do, how they can learn from you, and a little bit about how you got to where you are.
Sure. Yeah. Like most of us, I wasn't born with a silver spoon in my hand or a CFP certification after my name. I had to learn about money like all of us the hard way. And I graduated from college, me and my wife. We had 3 private school degrees between us when I graduated in 2008. A great year to be looking for work, by the way, Axel. So we also came out of college with about $120,000 of student loan debt. Mm-hmm. In today's dollars, that'd be almost $250,000 with inflation, with no real jobs. Okay. No real plan to pay off the debt, no real focus toward money at all. And that was the start of our financial journey. I mean, talk about, a great start in life. So that's kind of where things began for my wife and I. But I'll take us back even one further step. And this will be a story relevant, I think, to our conversation today. Okay. I was like 5 years old when I had my first memory about money. Mm-hmm. And apparently I'd collected a little tidy sum of cash in a paper bag, allowance money, chores around the house, stuff like that. Right. And I'd collected as much as $50, mm-hmm. which for me as a 5-year-old, that was a good chunk of money. And my mom, being a good mom, she took me to the bank to open up a savings account with that money. Mm-hmm. And I got to tell you, I was skeptical about handing over my hard-earned cash to this absolute stranger in a suit and tie at the bank, right, thinking he could do better with my money than I could. Yeah. Little did I know as a 5-year-old how correct I was at that moment. I've been wrong about money a lot in my life, but I was dead on with my skepticism toward banks. And that is true right up till the present now. We're 11 years into a financial practice that we started in the midst of the Great Recession. We started the practice and it's still going strong today. We've got hundreds of clients, almost 1,000 clients all around the United States and some around the world. And our focus and our practice has been focused on specializing in helping people fire their banker and become their own source of financing.
Yeah, that's very good. Thank you for describing that. Actually, it brings me back a little bit because I was raised by my grandma, because both my parents and in Germany, where I came from, went to work, which was at the time relatively unusual in the mid 60s. But so the same thing happened, and the German media, so to speak, I would say at the time, made it a little more juicy for parents to sell this idea to their kids by inventing something that they called the Jeans Savings Book. It was literally a little book. I mean, there was no digitization or stuff like that. That looked, even though it was made out of paper, it looked like it was made out of jeans cloth, which we all knew. Mm-hmm. And it was basically an annual tradition that you took your little jeans savings book to the bank to get your interest recorded. Now, for the younger audience, so there used to be times where there was actually lucrative mm-hmm. interest. Mm-hmm. Mm-hmm. One thing you mentioned that I would like to touch on real quick, because I think sometimes, these little nuggets are really, really important information in this context. You said you had already developed a skepticism towards banking and bankers when you had to turn over your hard collected, I guess is probably the right way, funds or money at the time. Can you say a sentence or two? What gave you that skepticism?
Well, it's literally the physical handing over of what I thought was, an asset. We can debate about whether dollars are really assets or not, but I was going to hand over the green stuff, the coins right. and dollar bills, over to a stranger, and he was going to put it somewhere out of my sight. And remember, as a 5-year-old, it's all concrete operational thinking at that point. There's no esoteric ideas about savings accounts, even savings books and checking accounts, and online wasn't even a thing back then. For me, it was just the literal disbelief that he was going to hold my money over here at this strange building that I've never been before. He's going to hold all the money that I've collected. You're right about the word collected over these years.
Yeah.
And then I can come and get it anytime I want to. Are you sure? What if he spends it? So there was that just very naive purview about bankers.
Mm-hmm.
And what I've come to realize now is that is absolutely the truth. And here's what I mean. FDIC insured banks. If I put $10,000, let's say, if I put $10,000 into a savings account today, out of that $10,000, the bank is only required to keep, are you ready for this? About $1,000 of my money on their books, in their vault, so to speak. So what have they done with the other $9,000? I gave them 10 grand, right? Well, they've loaned out the other $9,000, and they only have 1,000 of my money actually in their vault. Now, let's stop and think about the whole process here, because again, it's all one world. It's all one pool of money. The ocean covers the earth. All the water of the world is just one pool of money. So if I put 10 grand into the bank and I'm getting 0.1% interest for my deposit, right?
Yeah.
And then let's say you come behind me in line and you need a loan. How much, again, they're going to loan out the 9 grand to you. And how much interest are they going to charge you? Well, maybe it's 5%, maybe it's 10%, maybe it's 18%, but they're going to charge you much greater, right? Yeah, much greater than my 0.1% that I'm being paid.
Yeah.
Now, that is an incredible, in fact, that's an infinite return.
Right.
An infinite return, because how much of the bank's money did they have in that deal? None.
Yeah, exactly.
Now, okay, let's keep walking this story out. So Axel, let's say you now have a $9,000 loan from the bank. You got 9 grand. Where are you going to put that money before you spend it? In a bank account.
Me, I would put it into a real estate deal, right?
Well, sure. But even before that, as soon as you get the bank loan, before you buy your real estate, it's got to go into a bank account, right?
Yeah, as short as possible, but yes.
Yes. And what do? Well, as soon as you put that money, that 9 grand goes into a bank account, what are they going to do next? Well, they're going to hold 10% of your money. So 9,000. So that means 8,100 gets loaned out to the guy behind you in line. This continues to happen as many as 18 times. They can multiply the money.
Yeah.
And this is how banks are regularly the wealthiest corporations on earth. In fact, there's a great book that I see some of the incredible reading that you do back there. I know some of these books behind you there. That's awesome. Check out the book, Debt the First 5,000 Years. It's by David Graeber. Great book, really thoughtful book about the history of banks and more in general, debt. If debt has existed for 5,000 years, we can safely assume that banks are the most profitable, most long-lasting businesses on the face of the earth.
I totally agree with that. That's why I said, if I were to get those $9,000, that would be in there as short as possible. Mm-hmm. But there's also this other aspect, and maybe we are kind of tag teaming a little bit on this. What a lot of people don't really understand, and I think this is one really big thing why I believe financial education needs to increase substantially, should actually be taught as a class in school or a continuous training in, like, as you take math and English and that kind of stuff, it should have financial education and money education. Because people, and I was the same way, I guess you were the same way when you brought your collected money, and I did the same thing with my little jeans book, savings book to the bank. But one of the points is those $10,000 that you mentioned, the misperception to really see how can you make your money work for you, because it's not just the 9,000 that I would get if your bank loans 9,000 to me. The total 10,000 is a loan to the bank. It is, in a sense, not really your 10,000 anymore. Mm-hmm. At the moment you turn it over and they put it into your account, all of it is a loan to the bank. Mm-hmm. Funny thing is, we've gotten so far, and I don't want to get political about it, but we've gotten so far that they don't even need you to sign anything except for the opening of the account. And then the assumption is you are totally aware that every time you put money into your bank account, and this is true savings and checking, Now, yes, FDIC is there in the United States to basically secure you as the person up to $250,000. In Europe, by the way, it's only 100,000 euros. But there's a difference between what would happen if the bank goes down, which, if I hear you right, Mark, it's a very unlikely scenario that they would ever go down. So then, we don't want to have more than 250 in an account. But the realization that it's no longer your money, that is something that really struck me when I first started studying this stuff. That I always thought, and I don't know how you felt, you said you felt uncomfortable, but I would bet that you didn't think that you're literally giving it away as a loan.
Oh, yeah. It becomes the bank's liability to pay us back anytime we want it, which that anytime we want it part, that's why we're being given such pathetic interest right now, that instant liquidity there.
Yeah, and there's also the other component, and I want to kind of finish this part, but I think it's important when we talk about money to realize when you have your bank statement, anytime you go to an ATM machine and you say, tell me first, what's my balance? And it says $10,001 3 years in because you got $1 in interest, right?
Yeah, right. Mm-hmm.
And you say, okay, I want 9,000. At that machine, let's assume the machine had that money, you wouldn't get it.
Right.
Yeah. Because the agreement that they keep funds available for you, if you want any, does not mean that they have to keep all your funds available at any time for the full amount. That's why they can legally say you get 300, 400, 500 a day, even though you have a balance of 10,000. If you say, I want my 10,000 in cash,
right.
Most branch offices will tell you, sorry, Mark, we don't hold that much cash here. We have to send you to the main office somewhere in town, if they even have one, and on and on and on. So I think this sets a really good starting point, even though we talked about it for a little while. But I think it's important for people to understand this is a transaction. Mm-hmm. It's not where you put something to hold for you. It's a transaction. And then the question really becomes, what kind of other alternative transactions can you do that are much better for you? And maybe since you are an actual CFP and not like me, just somebody who is educating, but you have that certification. So if somebody said, wow, I never really understood this, I see now this is a transaction where I give somebody a loan. What else could I do that would be better for me? And maybe work with Mark on that. What would you say?
Like I say, and like the book by David Graeber suggests, banking will exist beyond the stock market. It will outlast. I suggest there's something called the Lindy effect, where for as long as something has existed, it will continue to exist. Mm-hmm. That's the concept of the Lindy effect. This is why some people have suggested that the landline phone will outlast the smartphone, because it has been around for 100 years. It's likely to outlast the smartphone. That's the Lindy effect. Whether that's true or not, who knows? But the idea there is banks and more precisely, banking is a fundamental reality to human existence. Banking it's a verb, just like parenting or exercise. The concept of banking is something that will be a part of the human experience, I think, for at least the next 5,000 years, right? So we might as well participate actively in that experience. And my presumption as a certified financial planner is that we are all in the banking business. Even if we just pay cash for things, even if all we do is real estate, which I recommend folks do. And I think folks need to work with you in terms of out-of-state turnkey properties. It's an incredible strategy. I've seen it work with our clients. So folks need to reach out to you regarding that. But how we engage the banking world really matters. It matters more than what your 401k did last quarter. It matters more than how much interest you earned on your CD at the bank last year. Banking is a function that you can take back control of. So if banking is a verb, well, who is the noun? I feel like too many of us have outsourced the noun to the bank down the street. We're going to let that bank over there do our banking for us. The trouble is we're in their business. We are their product. And when we outsource our banking function, they rip us off. I mean, there's no other ifs, ands, or buts about it. you might be making. I'll tell a quick story. We had a doctor who made very good money. He was very proud of his 12% a year on his mutual funds inside of his 401k. Made a great income. But as we looked at his overall financial situation, we sat down. It was over Zoom. We do a full financial analysis with everyone we work with in an advisory role, just to kind of figure out what the goals and concerns are for each person. And just like with him, we got to looking at his numbers, and he was spending, he had 2 boats, he had 2 houses, he had 3 cars, he had a student loan. All of that debt amounted to over 30% of his income, his after-tax income, going to service the banks. All of them were low interest debts, 4%, 3%, 5%.
Right, yeah.
But it was the volume that was killing him. It's just like eating, right? It's not the rate by which I eat food. It's the volume that'll make me fat. So it's the volume of interest that will kill us if we're not careful. And the average American, according to the U.S. Commerce Bureau, spends 37% of his or her income on servicing debt. 37%, Axel, that's like a third of our day. If we're looking at time as money, that's a third of our day. So, so
yeah, right. If you think about it from a working perspective.
Yeah.
Right?
And Axel, throw on taxes, and we might be halfway through before we're even working for ourselves, Yeah,
so, I think that's really an important point to make, Mark. We should always ask ourselves, why are we behaving this way?
Yeah.
Right? And it goes ultimately to when we're talking about financials, some of it is, like you said, with your opening story, related to how have we been raised? What did our parents tell us is the right thing to do, or literally showed us by taking us by the hand to the bank what supposedly is the right thing to do? But it's also the cultural and social pressure, right? Like when you go to your doctor, example, I would assume, I don't have proof, but I would assume that one of the driving factors is not just having fun, because there's a ton of different ways you can have fun, but culturally and socially, for decade after decade after decade, people have been conditioned to believe that success is shown through consumption, right? Mm-hmm. If I have 2 cars or a better car or another new car or a jet ski and another boat and this thing and that thing and so forth, then the more I can demonstrate to the outside world that I'm massively consuming, whether I can afford it or not, then I'm showing my success. And when you go to, I'm sure we both know, the millionaire next door is not normally that extrovert, shiny person that consumes like crazy.
Right.
And it's not to say, you have to look in like, what's that show, like Undercover Boss or something, where you put on the ragged outfits and stuff like that to see how they treat people that don't look the part. But the message in that is, if we keep on going, and I would say this is true for both our audiences, our audience should be educated enough to say, I'm not more successful based on the fact how much stuff I'm consuming, right? And besides the fact is, it's, through social media and other means, we are basically constantly conditioned to believe in short-term instant gratification kind of stuff. That's one of the struggles when we have the conversation of how and why would be the out-of-state turnkey residential real estate strategy that we are proposing a good one. And people say, well, how long does it take? And I say, well, if your time freedom point is $3,000, $4,000, $5,000, $6,000 a month, then it takes 8 to 12 years to get to that point. But then you have a life forever, and for your kids and their kids, if you want to, without any worry anymore. So if you are 35, put in 8 years or 10 years even, then you're 45 and never have to work again. How attractive is that? But it feels long. It feels like almost unimaginably long. So coming back to the point I saw on your website when I did a little bit of studying, that you say there's a way you can be your own bank. You want to talk a little bit about that?
Well, sure. Yeah. And your comment reminds me of Gloria Steinem's quote. She says, rich people plan for 4 generations, right? And poor people plan for Saturday night.
Yeah, right.
So given that 8 years, 10 years, whatever you're going to blink and it's going to be gone. Right. And to set up a 4 generations and more strategy, Goodness, I can't think of a better way to spend my limited days on this side of heaven, getting ready for something that my kids and their kids and their kids will talk about someday. That's just a tremendous, tremendous strategy. So yeah, if we're already in the banking business and we're just sitting on the wrong side of the banker's desk, then I like to look at small hinges that swing big doors.
Right.
Yes, we can all fiddle with our rates of return. We can pick that stock or that crypto or whatever. And it's good also, I think, to do that. But if we want to have a tremendously large impact on our financial life, the question is, how are we going to buy the stuff in our life? Everything from our turnkey rental properties to our kids' college education to our next car to the kitchen that needs to be remodeled. All that stuff, that's going to be millions of dollars that will pass through our hands. And it's either going to be paid in one of 2-3 ways.
Right.
The average person either finances it with a bank, and under which they are then under the thumb of that bank for the next however many 3 to 30 years, on their interest schedule, on their payment schedule, and more. Repossessed if the person doesn't make those payments and more.
Right.
Or they lease it, which is even worse because then they have to give up whatever. They can't even sell what they had been renting the last several years. Or they save up and they think they're beating all the banks and they're saving up and paying cash. Now, what's the problem with paying cash for things like, a car or a real estate deal? If you're paying cash, you're technically, you're not in a loan, but truly you are financing it from your future. The truth is you finance everything you buy. Either you pay a bank interest or you pass up interest you could have earned on money had you not bought that car or whatever and left it invested instead. So in truth, the real price of buying a car with cash is huge. Like, if you're buying if you're saving $350 a month for your cars over your lifetime, and you're buying cars every 5-6 years at $35,000 a year, let's say, that cost, if you just put $350 into a interest-bearing account, earning modest middle single-digit returns over your lifetime, you'd have lost out on $900,000 just because you paid cash for cars. Now, if you just ridden shotgun in the cars that your buddy drives, you'd have had $900,000 in your account at the end of life, right? So the price of paying cash is we're stealing from our future self. It's the concept of opportunity cost. Does that make sense, Axel?
Yeah, totally. Absolutely. And I think it's a good example to use cars because you have not even touched on the fact that, the moment you paid cash or got a loan for that matter, this thing lost 20 or 30%.
You're right. Yeah. Yeah. Not even factoring that part of it in.
Yeah.
Now, we can multiply this to vacations and real estate deals. And again, all the things that we were going to have to buy anyway. So I've discovered in my research as a certified financial planner, a strategy that lets us fire our banker and even beat paying cash. And it struck me when I found it. It was so simple. It was so old fashioned. I almost looked over it. Of all things in the financial universe, Axel, I didn't think I'd be talking about dividend paying whole life insurance here, but a whole life insurance policy, if it's designed correctly, can be designed to function like a bank. It's not an FDIC insured bank account, thank goodness. But it functions like a bank, and we can use it to take back the banking function in our lives. I'll share very quickly how we can do that if you'd like.
Yeah, totally.
Okay, so a couple of very quick kind of ground rules. This is not whole life insurance that you've heard Dave Ramsey talk about. Okay, very, very different from that. This has, massive cash value right from the start. We're cutting the commissions and the death benefit down as much as we possibly can. Typically by about 70%, we cut down those expenses. So that floods the policy with something called cash value. Cash value is if I could call it the living benefit. It's the money we can spend on this side of the grass. Right. And that's the fun time in my life to spend as well. I'm still alive, in my opinion. So having a ton of money, liquid equity in my policy, in my cash value is great because that begins to be a source of money that I can then use. It's guaranteed to grow for me every single year outside of the stock market. Guaranteed. What's guaranteed about real estate? What's guaranteed about Wall Street? it's accessible to me at any point with no taxes due. That's also tremendous.
Yeah, that's a huge important thing for people to understand. And I, if I may interject, for anybody in my audience who is somewhat familiar or has heard about the concept of a home equity line of credit, there are very strong similarities in that way, right? Like you're basically saying this thing is increasing in value while I'm basically sitting in it.
There you go.
I can go and take some of that out. It's not considered income, and you can do really cool stuff with it.
You actually bring up a great point and leads right to the next piece of this. While it is a lot like a line of credit, let's say I've got $100,000 of cash value in my life insurance policy, and I borrow against that life insurance cash value. I can do that. I have the right to. In fact, it's contractually guaranteed that I can always borrow. Unlike a HELOC, a bank can freeze that HELOC or even take it away from me, right? A life insurance, well, they certainly did in 2008. So they froze those lines of credit or even took away those lines of credit. But with life insurance cash value, it is guaranteed that I can access that cash at any point during my lifetime via a loan or a withdrawal. But just like a HELOC, my policy will continue to grow uninterrupted on the entire asset, the full $100,000. So let's say I borrowed 30 grand out of my policy to buy a car. My policy, I'm driving my car around town, enjoying that, but I still have the increasing compound growth on all $100,000 as if I hadn't touched the money at all.
Right.
That is not unlike a home equity line of credit. If I had $100,000 of equity and I borrow 30 grand against my house doesn't care if I have a HELOC. Zillow still counts my house, whatever. Right. The only difference is the home is not guaranteed to grow. See reference 2008, right?
Yeah, although I would have to say, you could also say, look at the current inflation rate and how it's increasing, right? And even if it doesn't grow in real value just by inflation, it would keep growing just at least at the inflation rate. I'm not saying it's the same. Don't get me wrong. And by the way, actually, I'm not just asking you to describe this. I'm doing this myself. So I want the audience to know this is a great thing. And the only thing in the example that Mark is using that I would change is I wouldn't buy a car. I would actually take the 30,000 and say I buy an asset that is actually producing income instead of basically burning the money, so to speak. So far, electric car. I don't know what we're going to call that.
I completely agree. The car is the simplest example because, but then you get really interesting results. Now think about it this way. If we're going to buy, let's say, a real estate property, an out-of-state turnkey property, and let's say we want to buy it, let's just keep it, again, very simple. And let's say we had $250,000 in our cash value life insurance policy, and we just use that to pay all cash for a deal, out of state. What has happened there? Now we have a real estate property giving us cash flow, and maybe we're doing cool things like cost segregation and bonus depreciation. Right. We've got appreciation in the market, hopefully, not guaranteed, but hopefully. And let's say that's 4% every year, maybe even better. And at the same time, even though we've borrowed against our life insurance, all of that $250,000 is still earning capital, guaranteed plus dividends inside of our cash value, inside of our life insurance, as if we hadn't touched the money. So we just turned one asset into two assets, and we increased your market return, didn't we? Without any additional risk.
And if you really want to blow people's mind, if they work with you and me together, we would get your help to get this all set up that way. And then they come to me and I would say, well, if you have really $250,000, instead of buying one or let's say maybe two properties, I would say, let's buy 10.
Yes.
An 80-20 deal where your investment part on each of the properties is only 20%. The bank pays 80%, totally normal, no mortgage insurance, no nothing. Now, if you buy 10, right, with let's say 30,000 down, so you have 1.5 million that came out of these 250,000 that is still there, that is still increasing. And the 1.5 million is the new asset value that you have on which, let's just say, for simple calculation, you make 4 or 5% increase in value just because of inflation and a few other things. Now, even though you only have 20% in that deal, and 80% is from the bank,
Mm-hmm.
by law, you earn all the benefit, all the gain, right? So the tenants in your properties are paying for the 80% that you borrowed from the bank, but the 4% is like what, $60,000 or something like that.
Yeah.
You make that as income, and that is why people oftentimes, when they say, okay, well, how much can I make in real estate? It's only 3, 4, 5%. Well, forget. Normally, when you come to me, or I'm sure, Mark, when they come to you, we would never recommend to buy these properties cash. We
Correct,
would say, get yourself a reasonable loan, 2080, at 4%, 4.5% interest that is easily paid with cash flow from your tenant, plus maintenance, plus property management. All of that stuff is included. You're still going to make a few $100s on each one of those properties, but more importantly, on the whole portfolio from that one deal, those $60,000 are completely your benefit, the whole of it. You don't have to give anything to the bank, right? Because you basically have, and I hope you agree that that is a proper use of the term, increased massively the velocity of your money.
Velocity of money is a great, perfect term for that, Axel. Yeah, exactly right. I mean, you just gave a number there, 60,000 increase divided by your $250,000 contribution to those properties. That's a 24% annualized yield right there. Yeah, and that's compounded.
We haven't even looked at tax benefits, appreciate any of those kind of things, the cash flow that comes out of these 1.5 million from the rent and all of that. So when people, they ask me, what can I expect to be the return? And I said, when you take it all in, it's not a good deal if you don't make at least 20%. And they look at me and say, I thought it's real estate. How can that be? Right now, you have to go and understand a little bit and work with either with somebody like you, Mark, or come and learn about our system and our mentoring program. But fundamentally, there is, and this goes back to the point about why we're doing these shows and why we bring great guests like you on, is to really help to educate people who say, I want to do more with my money. And it's a little sad to me, actually, that we have to go all the way back, like when you and I were little and went to the bank to make a deposit of $100. But that's where you really need to break the paradigm and say, you have to think about it differently. And I always feel like both of us and others in our professions, we are at least as much educators in this fundamental stuff as we are showing a particular strategy like ours or yours that help people in a specific way to accomplish their goals.
That's it. Yeah, that's exactly right. What we're doing is we're now thinking about this in terms of function, like where we put our money will make it act differently. I don't know who might be listening to this. I don't know what your goals or dreams or hopes or concerns are for the future, but I can tell you that where you put your money matters, because where you keep your money makes it do different things. If it's in a 401k, it's going to act different than if it's in a hedge fund or an annuity or a real estate trust or, savings account. It's all buckets where your money acts differently. So the key question for almost everyone we ask and talk with is, what do you want your money doing for you? What characteristics, what attributes would you want your money to have? I say it a little bit different, and maybe you feel free to steal it, is how does it look when you are the boss of your money? That's great. Yeah. Because if you are the boss of your money, you tell your money what it's supposed to do for you. Right. I like that. Yeah. And when we, in phraseology, maybe I'm a little sensitive because I didn't grow up with English as my first language. But the point for why I'm pointing this out is really to say most of how we describe it is we're putting it somewhere, we're giving it to somebody, we're buying, meaning also we're getting something in return. If we were able to adopt a philosophy where we can say, you need to be the boss of your money. You need to tell it what to do and find the best ways to make it as efficient as it can possibly be for you. So you, like most people who have a job, would say, well, it always looks to me that I do all the work and the boss is doing very little. Well, if you're the boss, that's your role. And so finding the most efficient way to make your money work for you, I think, is really, really important. Yep. I think we encapsulated that pretty well. I would hope that people learned a lot from that. Are you ready for a couple of quick questions that we always like to ask at the end? Well, sure. And if there's time enough, I'd be happy to give an example of what we've just described with real numbers in 2 minutes or less, if you think that'd be a good use of time. I'll give you 3. Okay. All right. Well, here's a real life example. A gentleman, he was 45 when we started working with him. He felt like he could contribute $32,000 a year to a whole life policy designed for massive cash accumulation. Now, right there, that stops a lot of people in their tracks, and they say, "Well, how in the heck? Who would be stupid enough to put 32 grand a year into a whole life policy?" Well, we have such fast accumulation that this feels more like a really souped up savings account earning 500 times what banks are paying these days in terms of yield. So middle single digit returns, 4 to 6% tax free. So after 10 years, he's got over $400,000 of cash value ready to use and access for any reason. And in that 11th year, he borrows against his life insurance and he stops paying any more into the policy. So he's funded it for 10 years and then he's done. And he's got 400 grand of cash value in the policy. And by the way, a $2.1 million death benefit, nothing to sneeze at there. Okay, so in the 11th year, he borrows $350,000 and he buys a bunch of real estate with that money. At the same time, he starts repaying that loan over 5 years, okay, with rent money that he's getting from tenants and more. At the same time, his policy grows from $400,000 to $515,900. So that's an increase of basically, $115,000 on its own, even though he had borrowed basically everything out of the policy, right? That's almost like an infinite return. Sounds familiar, right?
Yeah, exactly.
So, and the policy itself, they charge some interest when you borrow against these policies. There was about 38 grand of interest charged over the entire 5-year period. So we have to factor that in, Axel, when we borrow against life insurance, there is an interest rate. But again, if I'm going to pay 38 grand and on a guaranteed basis get back $115,000, how many times would you do that deal?
All the time. And actually, I always advise people take the portion of the cash flow that covers the interest and just pay it right away. So you don't really accumulate anything. And it's just flat the number that you borrowed and nothing else.
And that worked out to about a 1.9% interest APR for that gentleman. Now, we're not even looking at the number of real estate properties that he got, what the appreciation was. And that's where you come in. But it's a lot like, the work you do and the work I do, it's almost like nitro and glycerin. They go better together. It's like Batman and Robin, Thelma and Louise. There's just a great combination when you can put two assets together to make a even better result for your clients. That's
rockets, right? So it's fuel and oxidizer.
Oh yeah, I love that. That's great. Yes, that's right. So where else can we get that money doing two things at once? I can't find a 401k that can do that. I can't find savings accounts. Certainly not. So do what banks are doing with their money.
Right.
Don't do what they're telling you to do with your money.
Very good. Cool. So we used a little bit of our time up on this one. So I limited to one question, but most of the time it really has interesting responses. So I want to ask you, if you had a time machine, you can go forward or backward, where would you go and why?
Well, I saw that question in your notes and I've been thinking about it. And while I probably could come up with 24 answers, totally. Just to keep it relevant to this conversation, these policies, these whole life insurance policies have been around since before the American Constitution was written. In fact, Benjamin Franklin was a co-owner in one of the first mutual life insurance companies in the United States. It would be so cool to meet Benjamin Franklin. I think he has one of the best entrepreneur hearts, best minds. And so I would love to go back, meet, talk with, understand his philosophy, his strategy, kind of what he saw. I don't know if you know this, but he deposited several different deposits of 10 grand into an interest-bearing account that could not be opened. It was for the city of Philadelphia. And the first one was opened 100 years after his death. The next one was opened 200 years after his death. And they were tens, hundreds of millions of dollars had accumulated based on those two deposits that he made all those many years ago. That is long-range thinking. That is somebody thinking, 4 generations into the future.
Yeah, absolutely. And thanks for describing that. Yeah, that would be a totally new show, piggybacking on what we just discussed on compound interest, right? Because that is actually a very cool phenomenon too, to say, how does that actually look like with a compound interest? So That's really cool. Thank you for picking that particular place in history. So for all the cool stuff that you shared, how get people a hold of you the best way if they want to first see, how do I get the whole life insurance policy without having to pay the first 2 years just to satisfy an agent and stuff like that?
Yeah, that's a great way to put it. And that's exactly right. Most whole life insurance out there is designed for commissions first, which is a shame. As a certified financial planner, I don't think I can honestly recommend that type. For most people, if you're focused on cash accumulation, that you just really need to work with I'd say the best way you can look into this is look up the phrase bank on yourself. That's the credentialed, trademarked phrase that helps us distinguish this type of whole life insurance from, the old fashioned type that Dave Ramsey loves to hate on. Right. So, look up the words bank on yourself. You can find our podcast wherever you're listening to this show. You can listen to Not Your Average Financial Podcast. Right. And we've got over 200 episodes where you can learn more about this strategy. Or if you want to just chat with me for 15 minutes, go to Not Your Average Financial Podcast and click on Request a Meeting right there, notyouraverageFinancialPodcast.com. And there's a button that says Request a Meeting. Happy to chat.
Thanks for listening, and I hope you enjoyed today's episode of the Ideal Investor Show. More info and the links we mentioned during the show are in the show notes, or you can go to our website at idealwealthgrower.com and find them there. Sign up for the Apple Podcast link, the RSS feed, the Spotify link, and if you like to talk to me, please sign up for a strategy call at idealwealthgrower.com. So hopefully you want to share what you learned with your network and bring more people in. We are really eager to hear your comments. And until next time, be well, stay safe, and ciao.